Steve Lipper, the Russell 2000 index has significantly outperformed the S&P 500 so far this year. So in your opinion, why are the market's minnows outperforming its whales?
Yeah, I think the Russell has a number of components, small caps in general, that are preferable in this environment. You tend to have more international exposure, significantly more in the multinationals than you do in the smaller cap. That's favorable. You tend to have, actually, healthcare has been, in biotech specifically, some of the small stocks there. They've benefited from acquisition. And the third thing is you have more energy in the large cap area. So all in all, you've got a much more favorable environment.
Can you dig deeper into the sectors that investors should look out for when it comes to small caps heading into the second half of the year?
Yeah, so what's worked in the first half has really been non-economic sensitivity, most specifically around biotech. And actually, surprisingly, some of the research that we've done has shown that companies that aren't earning money are actually outperforming the most. And so we would be just wary about that. We think actually you want to tilt the other way towards economic sensitivity. When the company managements that we talk to, we think that we're going to see an economic acceleration from the pace in the first half. And so whether that's consumer discretionary or industrial companies, that we think that they're well placed to do well.
And what happens when rates, and they will eventually rise? Because one would think that larger caps can withstand rising rates better because they have bigger balance sheets.
Yeah, I would go probably the next level down versus capitalization to look at the balance sheets, right? So you have highly leveraged large cap and highly leveraged small cap. And I agree with you, rising rates and certainly rising credit spreads are to disadvantage of more levered portfolios. But within small cap, you have companies that generate free cash flow, excess free cash flow, have the opportunity to reinvest that in their business or to acquire a competitor, raise a dividend, or buy back shares. So we agree with you, rising rates brings the balance sheet back into the discussion, so lean to the companies with better balance sheets.
And then finally, since you can parse it at this level, what about growth versus value?
Yeah, so I would, again, so within value, I would distinguish between interest rate sensitive and economically sensitive. So the interest rate sensitive, to your point, as rates rise, things like utilities and REITs probably continue to have the wind at their face. They have not had a great first half. The economically sensitive, again, the industrials, some of the consumer names, perhaps some of the housing names as well, better. Growth, again, let's be wary of companies that aren't earning money. You know, that can be okay maybe for a portion of your portfolio, but investing for your retirement, we would be a bit cautious on that.
All right, thanks a lot, Steve Lipper.
Yeah.
And thank you for watching The Street.